Okay, folks, welcome to the 2019, the year ahead forecast. This is Bob Desmond at the Contrarian Trader. We have a lot to go over today. Thanks for joining in. Happy New Year. Happy 2019. I hope you have a happy and healthy one. So what we're going to talk about today are some of the calls that I made last year on the 2018, the year ahead commentary. I'll link to it at the end of this video if you'd like to watch it. Then we're going to talk about what we're seeing on the charts of not just the major averages, but sectors and the bond market as well. But first, what I want to do is I want to share with you the macro concerns I have about the global economy and what the threats are to the U.S. economy. At current, we have a trade war with two main countries. Forget about Mexico, forget about Canada. Those have been resolved for the most part. The two countries we have a trade war with are China and Germany. Now, with regard to China, you're seeing a lot of economic data coming out of China that is not looking good. I have contacts in China, and they've shared with me, you have companies that are packing up and leaving the country. Vietnam is going to be a beneficiary. India will be a beneficiary. President Xi of China is under a lot of pressure, which raises the risk of a conflict in the South China Sea. So those are some of the concerns that I have. Moving onward, we do have quite a bit of unrest, civil unrest in Europe, especially France, Germany, Belgium. It's not being spoken about here in the United States in the mainstream media, but you have a conflict between nationalists, those who are proud of their country, versus the globalists. And you are seeing yellow vest protesters get mauled by police. You're seeing the restraint of free speech, not just in Europe, but you're seeing it here in the United States, by and large, by many of the FANG names, plus Apple. But I think the markets will resolve that problem because they are really taking it on the chin now in terms of damage to their brands and their share price. And you may be waiting for me to get to the government shutdown here. Let's face it, I could care less if the government never opens back up again. And were I President Trump, I would drag this on for as long as possible because now you have the Democrats taking over the House of Representatives. You have a stock market which has taken it on the chin and in all probability will continue to take it on the chin. And as we proceed onward and into the 2020 elections, you can bet your bottom dollar he's going to be looking for somebody to blame. Congress controls the purse strings. He has the bully pulpit. So I wouldn't expect this to get resolved anytime soon. I could be wrong, but as I see it from a political view, he'd be foolish right now to let this go. Because the charts I'm going to go over, if he's getting any advice from market technicians out there, there is a lot of damage that's been done and will probably continue to get done. So what are we going to do about it? What we're going to do is normally I would put out immediately following on January the 1st our strategy session with members. I'm not doing that this year. What I'm going to do is I'm going to hold off for perhaps as much as a week, perhaps sooner, to assess how the markets are opening up the new year, what the news flow is like, because there's been so much technical damage done to this market that you really need to proceed with caution. Now, before I go into the charts that we're looking at for the coming year, I want to talk about a couple of calls that I made last year. One was the Dow Jones Industrial Average. I warned going into the new year, 2018, that we were very overbought. Here's where I spoke about it. We did put in a new year-over-year high. I predicted it. We got it. But I also predicted that we would get a sell-off, a correction. You had to expect it. We hit 90 on the Dow Jones Industrial Average. How could you not expect it? And as you can see now, we're putting in lower highs and lower lows. So we'll come back to the stock market averages, in particular the S&P 500 in a moment. But I also want to talk about another call that I made last year, and that was on the yield curve. This is a monthly chart I warned that we had broken down below critical support and that in all probability we were going to go lower. And talk about a narrowing of the spread between the 2-year and 10-year Treasury yield. And for those who are not familiar with the yield curve, it has been an indicator of recession for the past 7 recessions, and the 3 main ones are highlighted here. 1990, the dot-com bust, and then, of course, the financial crisis. And we broke down the month of November below the lower band of support, which we were trying to hold for several months. It failed, broke down to new lower lows. We almost inverted in December, but we were able to rally back and flash a bullish key reversal. The question is this a bottom? I don't think so. I don't think it is the bottom. So again, last year I warned, expect lower lows. We got the lower lows. I warned about the Dow Jones Industrial Average. It's overbought. Expect a correction. However, we'll probably put in a new yearly high first. We did it. Again, I'll link to that video at the end of this video so you can watch the full version. All right, so we're talking here about the bond market. Let's continue on with the bond market, because one of the major mistakes that people make are that they want to trade stocks, yet they ignore the bond market. And the bond market dictates where the stock market's going to go. Have no doubt about it. Now, this is a chart of the 30-year bond price going back to 1979. And you can see that we broke out into a new bull run we had the higher low here. Let's call it 1984 onward. This year, something major happened. 2 things happened, major. We broke down below the lower band of the rising uptrend channel and closed there. And we spent 3 months below that support level. But something fantastic happened. Let's drill down here. We managed to rally back and recapture that resistance level. And we closed there. Really spectacular price action on the bond market. And we even closed above a resistance level. So a very strong month. So what do we read into this? What we could read into it is that the jawboning of the Federal Reserve is having its intended effect on the bond market. So the question is as we proceed into January of 2019, do we put in a new monthly high, or do we gap down and then retest this lower band of support? And then finally, at the end of January, do we close above this support level, or do we fail? If we fail, that will be a very bearish event, because have no doubt, the rally back that we've seen in the stock market is directly correlated with moving on to the junk bond market. A lot of pressure here, because the junk bond market, the high yield debt market, is heavily influenced by the energy sector, which had a major breakdown this year. I'll get to that chart in a few moments, but this is a problem. And while we managed to rally off the lows of the month of December, that does not mean that we've seen a bottom. And what you're going to hear me say a lot during this commentary is that if we put in a new monthly low on the junk bond market, get ready for some real ugly price action, because that means that the energy sector, in all probability, has begun a new leg down as well. The TIPS, Treasury Inflation Protected Securities, they had a fairly good first 8 months of the year. In fact, we hit a high this year not seen since March of 2013. But what happened? The attempted rally was rejected and it rolled over and broke down to new yearly lows. So we did rally back the final 2 months of the year, but still we have a lot of resistance above now. Both lines on Stokes trading down below the 50 level. So while I'm optimistic that the TIPS can rally back this year, I am still a bit concerned. I'm not overly confident. Overlaid here is gold. You can see that gold is rallying with the TIPS, as both traditionally do rally together. And gold is going to be a topic of discussion with members on the week ahead commentary where we talk about our Q1 2019 strategy session, the VIX monthly chart. These will all be monthly charts, folks, because we want to get that higher level view of the battlefield. And you could see that the year started off, initially the VIX came down to retest the December lows of 17, but then flashed a reversal bar. And then it was off to the races through February when we got the top and we pulled back, went into a consolidation, a bull flag setup, and then in October we broke out, pulled back, did a retest in November. What happened in December? A follow through to the upside and a closing high for the year. So this does not inspire a lot of confidence in me where I long of the market. We booked a lot of profits on Friday in our small cap trade and half of our position in Goldman Sachs. The US dollar. The US dollar has been a topic of conversation in 2018. It will remain a topic of conversation in 2019 because the dollar is under a tremendous amount of pressure. And we have been building core positions in the gold miners, silver, in anticipation of a dollar break. And the dollar on this monthly chart, you could see, broke support in December. And now what we're doing, let's update this. Now what we're doing is we're flirting with the lower band of the rising uptrend channel. If that breaks, it spells a lot of problems for the US dollar. Now, I mentioned earlier that I had a major concern geopolitically, and that concern is with Europe. Now, the euro, this is a chart of the euro versus the US dollar, and you can see that the euro has been very weak. However, the month of December was very strong. You could attribute the strength to the resolution of the budget deal with the Italian government and the EU. But I mentioned earlier, you have a lot of civil unrest over in Europe. If that continues into 2019, which I predict that it will, we may see a muted rally in the euro, which could keep a bid under the US dollar. But as it stands right now, the dollar looks weak. The euro is gaining strength. The euro represents 60% of the basket of currencies that makes up the DXY, which is the dollar tracking index, the DXY, which I go over on Swing Trading Today most every day. So if we get a breakout above this upper band of resistance on the euro, expect a break in the US dollar. And that will bode well for our commodity trades, the transports. All right, so now we're going to talk about the major averages. Okay, so the Dow transports, folks, this is a technical disaster area. And I mentioned earlier that I will be talking a lot about putting in new monthly lows. That will be my guide for where we will go for at least the first half of 2019, because we broke down below the lower band of support of the rising uptrend channel the month of October. We had a continuation breakdown. The month of December, we rallied off the lows of the month. If we break down to new monthly lows, we're coming down here to 7,500. So a warning flag is on the track for the entire stock market. So as I went into 2018, bullish on the market, anticipating a new yearly high, which we got. But I also warned about a sell-off because we were so overbought on a monthly basis. The difference this year is that I'm going into the year bearish on the market. Will that last the entire year? I'm not that smart, folks. I wish I could say I were. Charting is not a crystal ball, but what it does provide you are a glimpse of what the probabilities are moving forward. And the glimpse that I'm looking at right now on the Dow transports is that in all probability, we will break to new monthly lows. Now, when does that story change? Well, if we consolidate along this lower band of support after retesting it, and then we build a base and we begin to break out, well then my thesis is thrown out the window and then I'm proven wrong. But we modify our decision making every single week on the week ahead commentary with members. So we will be in front of any change in our current thesis. So the transports looking weak, and I think they are probably going to get weaker. Now, in terms of charts that I look at as an indicator for the global economy, and especially the U.S. economy, I look at the Dow Jones U.S. Containers and Packaging Index. If the economy were growing, you would anticipate strong demand for containers and packaging. What do we have? Lower highs and lower lows. If we break 314.16 and make a new monthly low, we're coming down to 278 to 252. Volume on an abbreviated month of December, look at the volume, look at the distribution here. Stokes rolling over. So this is what we call a rules-based approach. I'm not looking to short the market unless the market tells me vis-a-vis a break of an uptrend channel. In this case, probably a weekly chart. If we get a break of a rising uptrend channel on not just the transports or the containers and packaging index, I wouldn't even know how to short the packaging container index, but on any index that is weak and getting weaker, we will look to short into the new year if they begin to break down yet again, because again, my anticipation is that we break support and we make new lows in 2019. The Dow Jones Industrial Average, we've talked about this already, but let's stick with it for a moment. So we were overbought this time last year. We became increasingly more overbought. What are we looking at now? We're looking at lower highs and lower lows on RSI and Stokes. These are forward-looking momentum indicators, and they are breaking down. Now, if we fail to hold the lows of December, which was at 25,980, we are going to take out this lower band of support and head considerably lower by a couple of thousand points. We could quite possibly head down to 18,351. And we will probably get there pretty quickly, which is the reason why I don't want to say for all of 2019 I'll be bearish, because stocks have a tendency to go down a lot faster than they do going up, because fear is a greater motivator than greed. So the Dow Jones not looking good. S&P 500 monthly chart. Now the S&P 500 has broken down below the lower band of the rising uptrend channel. This is a broken index. We have lower highs and lower lows in RSI. We're just barely holding on to the 2,500 level. It must hold, because if it fails, if we break down and close below 2,500, in all probability, we're going to retest the lows of December. If that breaks, it's all over. We'll revisit the market when the S&P 500 gets down to 2,134. Abbreviated month for December, yet volume rose above average. That's institutional distribution. Lower highs on Stokes, not looking good. The NASDAQ Composite monthly chart. Double top on RSI, money flow, leaving. We have a lower high and a breakdown on price. So the NASDAQ looks particularly weak. And I warned back in August, beware of these FANG stocks. These social justice warrior stocks were going to get hammered, because you had the NASDAQ, which was getting led up by the FANG names, yet you had the rest of the stock market, which was fading away. So you had far too fewer advancers, meaning you had your large cap FANG names leading the stock market higher and cloaking what was really going on in the market until, of course, they rolled over. So if the NASDAQ breaks down to new monthly lows and closes there below 62.50, we're coming down here. We're going a lot lower to 5,231. That's our next support level. Volume. Incredibly high volume for the month of December, which was again abbreviated. Take a look at the stochastics. I drew this back in, I believe, September. And I warned, watch for a break. We had lower highs on stochastics. Watch for a break to new lower lows. And sure enough, we've rolled over. And this is a broken index. Now, let's talk for a moment about the NASDAQ composite. How could it be salvaged? How could I change my mind here? If we gap up higher this coming week and we manage to close above 67.50, which is critical support, while I would not change my bearish tone yet, I would adopt a far more neutral one. And if we began to consolidate and flirted with a breakout above this upper band of resistance, then my tone would begin to turn bullish. But we are nowhere near there yet. So as it stands right now, net bearish on the NASDAQ composite. The Russell small caps, of which we just booked profits on last week, to the long side, we took advantage of the short covering rally. We were buying stocks when nobody else wanted them. They were selling the IWM. They were selling Goldman Sachs. They were selling emerging markets. I said, let's step in here. There's blood in the streets. Let's buy. And then we began to book profits on Friday. Now, what we're looking for here on the Russell 2000 is for the index to hold this lower band of support, which just happens to be where we bounced off of in the month of December. Now, if we retest and break down below this lower band of support, we're coming down here to 110 per share. That's a big drop on a percentage basis. And I think that's where we're going. Now, you may be saying, Bob, you saw a lot of buyers step in the back half of the month. We closed well off the lows of the month. It just doesn't excite me. The same could have been said back here in June of 2002. We rallied off the lows of the month, and what do? We rolled over in July, and we broke down really, really hard. Same deal here. The month of October 2008, what do we do the next month? We broke down to new lower lows. So I just don't think that the selling is over yet, folks. I could be wrong, and that's why I am waiting before I decide to strategize with members about what we're going to do for the coming quarter. I would rather, on a very short-term basis, just take a pause, do nothing, watch and wait, see what the markets do, and then take our cue from the market. Because either way, there's going to be a lot of money made. Now, I think there's a lot more money to be made to the short side of the market because the markets are still very overpriced and they are technically broken. Moving on. Consumer discretionary. Monthly chart. This is Starbucks, right? Companies of that ilk. RSI and Stokes breaking down. Lower highs, lower lows. We need to hold 90. If that fails, we're going down to 85. If that fails, we're going a lot lower. We'll probably head down into easily the 70s and quite possibly before we see a bottom into the mid-60s on the XLY. Again, folks, I know I'm being doom and gloomish here today, but there's a lot of money to be made to the short side. Now, this is a monthly chart of consumer staples. Now, one would think that during times of duress in the stock market that you would see a flight to safety into the staples. They pay a yield. These are your drugstores and whatnot. They pay a yield. They're considered stable, low beta stuff. What happened in December? We broke down below the lower band of support on a monthly basis. Ugly stuff. Lower highs, lower lows in RSI, rolling over on Stokes. And the markets were sending you signals on RSI. This is why I use the RSI so much, is that not only is an overbought and oversold indicator, sure, that's all good stuff, but it sends you a signal vis-a-vis divergences. Now that divergence happened here, where we put in a high back in December of 14. This is what happens when you use a monthly chart. December of 14, from that point in time, we made lower highs, lower lows, while the XLP continued higher. Then we surged. In January of 2018, we rallied up and through the 2 standard deviation Bollinger Band in green and kissed the 3rd standard deviation Bollinger Band in red. That was the death knell. So we had RSI, which had been putting in lower highs and lower lows, yet prices moving higher. Then finally, we broke. And here we are today. RSI, lower highs, lower lows, and price breaking down on massive, massive volume. The banks, monthly chart, broken. If the XLF breaks down below 22, we're coming down here to, we'll have an 18 handle on it. The banks are very, very weak. They closed down on volume for the month of December. Stokes, we have both lines on Stokes trading down below the 50 level. What does that imply? It implies that rallies tend to fade when you get this situation. Beware of both lines on Stokes trading down below 50 and declining. The semis, they broke down below support. Now, this is very bearish stuff. What happened here? We had a retest of support in October. In November, we had a bullish key reversal, a very good month. And one could have thought, wait a minute, we may have a rally setting up here in the coming months. But what happened in the month of December? It broke down. Not only did we break down and close down below support, we undercut the lows of November and October. RSI, lower highs, lower lows, volume very high. Both lines on Stokes trading down below the 50 level. Rallies tend to fade. Let's segue over and into the technology arena. This is information technology. You could throw Facebook in there. You could throw Google in there. Let's go to a monthly chart. This was the market for most of 2018. And here it was, right at the top. Go check out my videos on YouTube. Back in August, September, I warned, beware of these stocks. They were very overbought. And not only that, they were becoming social justice warriors, alienating their customers, setting the stage for new competition. Their valuations couldn't handle it. Their management was completely inept at handling crisis over in Facebook. And they had never been through a recession yet. So they had not been proven yet. They have high valuations and subject to multiple contraction. And what happened? We rolled over in October and we had continuation breakdowns through December. Is this a bottom? I doubt it. Might we rally back for a couple of months and then roll over? Probably. If we break down below the lows of December, there's a lot. This could drop a lot further. I think at a bare minimum, we'll come down here to 126 on the IXN. But in reality, we'll come down to probably the high 90s before all is said and done. It just goes to show you how one chart can show you how it could skew the NASDAQ composite. This one sector, because it certainly wasn't telecom. Here's the telecommunications index monthly chart. This sector topped out back here in January of 2017. Whereas again, information technology topped out in August of 18. Going back to telecom, do we have a bottom here? I don't think so. I would love to say that we do, but I'm very hard pressed to do that for a couple of reasons. One, we broke out here in August, rallied, then we rolled over. Now, had we retested as we did and closed above support in October, drifted back and retested the support level again and held, I'd say, you know what? Maybe this sell-off that began in 2017 in telecom, maybe it's over. The problem is is that we broke down and closed below the lower band of support. So this is a breakout point failure or a bull trap. There's a good chance that we are breaking to new monthly lows on telecom. Also, we have a head and shoulders setup, which is setting up here. Left shoulder, head, right shoulder. Here's your neckline. We're right at it. Volume, massive volume for the month of December. Let's talk about housing. Housing had a disastrous year in 2018. Why? Look no further than the rise in interest rates, which at their peak of the year were still at levels that are well below normalized. Yet the American consumer cannot afford a yield on the 10-year above 3%. So here we are flirting with lows not seen since October. It acted as good support back here and was actually very good support in January of 2017, and we launched higher. But we have now round-tripped it. The question is, do we hold 240.19? I don't think so. We had a good week last week, but I think that we're going to pull back and retest this support level here at 220 on the HGX. So if you're looking to buy the home builders, I would wait. Now, if we see the consumer hold up into 2019 and yields stay low, you may see a resurgence in the housing sector. I think it's way too soon to make that call. Again, what I want to do is I want to take the pulse of the market for the very early part of January and then make decisions. We have a large cash position, so I want to make my bets wisely and a time and place of our choosing. So housing, we may be near a bottom on housing, but I will warn, housing prices are beginning to roll over a bit nationwide. Oil, what a complete and utter disaster area the back half of the year. You would expect that if you had global growth, you would have strong demand for oil. What did we do? We broke out above resistance in January of 18, had a beautiful rally into October. Then we flashed a bearish key reversal. This was the market sending a signal, get out, especially when we undercut the bullish key reversal of September. Very bearish stuff, down on volume. What we're doing now is they're trying to hold the lower band of support. If this breaks, we could easily come, although I don't think this 865 level will hold. I think that we'll come all the way back down to 765 on the USO. I know when I go to edit this video, I'm going to be depressed hearing myself. So, folks, believe me, I don't like to talk bearishly about the markets. It's a lot easier just to be long. You have to be a lot more strategic and tactical when you're shorting the market. But this is the environment that we're in. Let's talk about the energy sector. This is one of those charts I want to go over the weekly chart first to illustrate what I've been talking about with members all year long. We had an absolutely beautiful inverted head and shoulder setup. Left shoulder, head, right shoulder. This green line here marked the neckline. We broke out of it in November of 2017. Rallied, pulled back to the retest, rallied onward. A nice rally. What did we do? We rolled over. And not only did we roll over, we retraced and broke down below the neckline. This is a major, major technical breakdown. And you can even see what the programs did, the program computer selling, when we closed down below the support level. They sold the dickens off of this. Look at the volume. Are we done going down? I don't think so. And if the energy sector breaks down to new lows versus the lows seen in December, watch out for the junk bond market, folks. It's going to roll over and roll over really hard because It's the junk bond market that financed the frackers. Let's take a look at a monthly chart of the energy sector. Let's take our crayon out. All right. What can you say? I mean, this is just bad. We broke down, failed breakout. They tried to take it up very hard. They tried to break it out here in August, September, then again in October. Then we broke down. And once we closed down below this lower band of support, you had to get out. And overlaid here is the high yield debt market in black line chart. And you can see that as goes the energy sector, so goes the junk bond market. Have we hit a low? Maybe, but we need to retest the lows of 2018 first. And if we fail to hold the December lows, we're probably going to retest, let's call it 27.25. That has been resistance and support a number of times in the past. They may try to defend that, but if that fails, we're going a lot lower. Probably down to a 24 handle on the IXC. The utilities. Okay, monthly chart. The utilities had a pretty good year in 2018. And it came on the heels of the Federal Reserve raising rates. And normally the 10-year yield, which I have overlaid here in black line chart, trades inversely of the utilities. So it was odd for a good portion of the year, the two traded in tandem, but all good things must come to an end. And unfortunately, I think that the utilities are breaking down. They attempted a breakout, and in fact, they did break out in December, but it was rejected. We broke out above 54.80, but we couldn't close there. What matters is where we close, folks, not where we trade intra-period. In this case, a monthly time period. And to add insult to injury, not only did we sell off the highs of the month, we undercut the lows of November. So we have an outside reversal month, which is pretty bearish stuff. Now, I'll also point out that RSI for a number of years now has been putting in lower highs and had only one lower low. So it's a divergence, but nothing scary. But once again, we're at the doorstep of possibly breaking down below the lower band of support on RSI. So if we get that, I would expect a follow through to the downside and a retest of this second lower band of support on the XLU. Lower highs and rolling over to lower lows on Ultimate Oscillator. Big volume last month. So I'm a bit concerned about the utilities, and the real rub here is that the 10-year yield is moving lower and the utilities should be moving higher. Now, why is that? Well, remember that you have fund managers out there who have portfolios that are solely focused on fixed income. They need interest income. So they will buy the utilities when yields are declining because treasuries aren't paying anything. They'll buy the utilities for the yield and plus the upside you get on the share price appreciation. But we're not seeing that premium on the utilities, at least for the month of December. So I'll be watching for a breakdown here on the utilities. And if we get that breakdown, I fear that we may get a spike on the 10-year yield. So let's be careful. Let's watch out for the utilities. They are our canary in the coal mine for interest rates. And I will acknowledge again for the year of 2018 that canary in the coal mine reliability that we've had for many, many years in the past was not a reliable one. But again, all good things must come to an end. The biotechs, major breakdown here. The BIB, we closed below 44.62 and significantly below. I wouldn't be a buyer of the biotechs until we saw a 30 handle, minimum 35, and ideally $30 per share. Stokes, very weak and getting weaker. We are nearing the home stretch here, folks, so bear with me. All right, gold, monthly chart. I have been bullish on gold, and I wish that I could say that I was 100% accurate with my call on the gold miners and gold throughout the year. I was not. And while we had a very, very strong back half of the year, And we really pulled it out with our gold mining position by buying when there was blood in the streets. They weighed on our portfolio during the first half as the FANG names led the charge higher. So what we're looking at here, monthly chart of gold, we are in a multi-month, multi-year for that matter, triangle formation. Now what we did in 2018 is that we put in a multi-year high. The high of 2018 was 1,369.40. The prior high was 1,377.50, seen back in July of 16. But we were rejected at the upper band of resistance. So we pulled back, retested support, it held. I think that we're going to move higher here. But again, folks, we need to watch the US dollar. The dollar must break for an earnest breakout on gold. So we remain going into 2019 very, very bullish on gold. For that matter, the gold miners here. You could see that on this monthly chart, we recaptured prior support. Do I think that we'll retest this? Absolutely. I think that we will, and that'll be a good thing, if assuming that it holds. And we were buyers at the lows in September. We held our noses and we went in. But as you can see, it did weigh on our portfolio the first half of the year. I will not deny that. So the gold miners looking good into 2019. Notice how I'm getting a little bit more bullish now. Silver, monthly chart. We have been long of silver for the month of December. We finally got the breakout on silver that we were looking for. We're very bullish on silver moving into 2019. We broke out in December on RSI as well, validating the breakout on price. Volume was very good. Stokes, like a coiled spring. Now, all commodities are not alike, right? So here's the GSG. This is a basket of commodities. And you could see that in December, we broke down below the lower band of support. Now, why would this happen when you have precious metals rallying? Well, you have copper, which is an industrial metal, was destroyed in December. Head and shoulders setup. Left shoulder, head, right shoulder. We broke down. This is a weekly chart. We broke down. And if you take a look at copper on a monthly basis, this is one sick puppy. We had an outside reversal month in December, meaning we engulfed the entire month of November and even took out the lows of November. So if we break $2.60 spot price on copper, we're going a lot lower. And this is another sign. I went over the packaging and containers index. We went over the Dow transports. Copper is another sign of global growth, as is energy. And all of them are very, very weak. What I want to do is I want to leave off today with emerging markets. Emerging markets had a horrendous year in 2018. Now, as with many of the charts I've been bullish on, which have only been a few, those charts hinge on a weaker US dollar for those charts to rally. The same holds true for emerging markets. So if you see the dollar break in 2019, it's my guess that we will break out on emerging markets. Would I buy here? Sure, you could buy here, but you need to use a stop right below the December lows. Because if that fails, we're going lower. When would I add more? I would add more on a breakout and a close above this upper band of resistance. I think that the domestic economy is probably going to come under pressure in 2019. I think that that pressure will lead to perhaps not a cut in interest rates, but a moderation of projection for future rate hikes in 2019. And if that occurs, that might set the stage for a late year rally in the stock market. Now, if we see a GDP contraction and inflation heads higher in 2019, that is stagflation. And that will set the stage for a massive rally in gold, silver, and you will in all probability see the stock market sell off really hard, because inflation implies that the Federal Reserve will raise rates. And if they raise rates with GDP contracting, that is probably the worst case scenario for the stock market. Again, is with inflation rising, GDP stalling or contracting, with a Federal Reserve that resists in pausing on their rate hikes. And that is it, folks, for the 2019, the year ahead commentary. Members, we will go over our strategy for Q1 2019 over the weekend. If you're not currently a member, please join up. Everybody enjoy the remainder of New Year's Day and have a very profitable 2019. And I'll see you on the charts. Be well.